In this video, I'll be talking about 5 things you have to consider before entering a trade. And it doesn't matter whether you are trading stocks, forex or crypto. And these 5 things are one of the most important things every trader should look into. Whether you are doing the smart money concept, normal price action technical analysis, indicators, no matter the strategy you use, these 5 things are very important for you as a trader to consider before entering a trade. And also in this video, I'll be diving into my screen so that I can show you all these things in a practical way so that you can see how I actually take my trades and how you also can replicate that into your trading. Hi guys, I'm Arab the Plug and welcome back to my YouTube channel. And this video, like I said, I'll be talking about 5 important things you have to look into before placing any trade in the forex market, crypto, or even in the stock market. The difference between beginner traders and advanced traders who are experienced is the fact that beginner traders tend to rush into trade. Once they see a trend line break, or a break of support, or a break of resistance, or a change of structure, they rush into that trade and eventually they lose that trade. Sometimes the trade hit their stop loss, take out their stop loss, and it start going in the direction they have earlier predicted. So this is one of the difference between beginner traders and advanced traders. And if you look at your trading journey very well, you will see that you have encountered this several times. And the reason why you are encountering this is because you do not have enough experience that will help you to navigate through all these processes before you actually place a trade. And this is one of the major differences between beginner traders and advanced traders. So after watching this video, you should be able to transform from that beginner level where you enter trade prematurely to that advanced level when you know the best time and you catch the best, you time the movement of the market and you're able to enter the trade, get the best entries for yourself and exit where you should exit. So those 5 things are the market structure, areas of value, how to enter and exit the market, risk to reward, and your psychology. So right now I'll be diving into my screen to show you how to do these things perfectly, and let's get right into it. Alright guys, so let's talk about these 5 things you have to look out for before you enter a trade. So the first thing I'll be talking about is the market structure. We all know that the market structure is either of 3 things in the market. So market structure is more like what movement is the market doing? Where is the market going? Where is the market heading to? Wherever the market is heading to is going to tell you where you as a trader should head to. So we have 3 market structures in the forex market. Whether you are trading forex, crypto, let's just say financial market. So the first one is the uptrend, right? The second is the downtrend, and the third one is the ranging market. So when you say uptrend, an uptrend is a market whereby is a situation whereby the market is making higher highs and higher lows. So let's say something like this. Let's say the market starts from this place, make a high. This is higher, this is high, low, higher high, higher lows, higher highs, higher lows, higher highs, higher low. So and the market continues like that. So the reason why we call it an uptrend is because in this kind of scenario, anytime the market moves up and reverses, it makes a higher high. And we call it a higher high because this high is higher than the previous high. So let's look at it this way. This is a low, right? This is where the market started. This is a low. Then the market went up, right? High. It came back again, and this is a lower high. This is a higher low. Then this is a higher high. So what the essence is that in this particular market, every time market reverses, it tries to push up again and beat the previous highest position. That is what we call it a higher high and a higher low. So I have a video on market structure, like a specific video on market structure. I'm going to link that in the description below so you can watch that. So the point is that you have to look at the market structure of the market before you can do anything in the crypto, forex, or stocks market. So you look at, is this market in an uptrend, downtrend, on a range? So this market is actually in an uptrend, and because the reason why I'm saying the market is an uptrend is because the market is moving up, is making higher highs and higher lows. And look at it. Let's think of this. The market starts here, went up, came back here, make a higher high, reversed, made another higher high, reversed back to this area, made another higher high, reversed again, higher high, higher low, higher high, higher low. Right? And this kind of scenario, we expect the market to push up again and make a new higher high. So in an uptrend market, if the market is trending up, what you want to do is look for buying opportunities, right? And then, apart from uptrends, another market structure we have is what we call the downtrend. It means the market is simply going down in a layman language. And when we say we have a downtrend, we have a series of lower highs and lower lows. So let's say the market starts up, move down, reverse a little bit, right? Move down again, reversed, move down, reverse, move down, and that is what a downtrend looks like. So in this scenario, we have a market giving us lower highs and lower lows. Lower highs in the sense that whenever the market tries to come down, it reverses back up a little bit. That is lower high. And lower low means whenever the market reverses up, it creates a new low. So in a scenario like this, you expect the market to make lower lows and lower highs in a downtrend market. And in a ranging market is always a choppy market, whereby the market is not going in a single direction. So let's say the market is doing something like this. So you can't really say the market is an uptrend or a downtrend if market is doing something like this. So we call it a ranging market or a sideways trend or a choppy market. In this kind of scenario, if you're a beginner trader, you don't want to be trading a ranging market because it's actually not giving you a clear direction. But if you're an advanced trader, you can actually time a ranging market and make money from the highs of the range. You can be selling the highs of the range and buying the lows of the range. And with this kind of strategy, you can actually do that. So market structure is actually one of the most important things you have to look out for in a trade before taking a trade. And you have to be able to identify the market structure in a chart. So once you identify the market structure, you already know what you are doing. If the market is in an uptrend, you want to be looking for buying opportunities. If it's in a downtrend, you want to be looking for selling opportunities. And if in a ranging market as a beginner, you want to look for a clear trend before you decide whatever you want to do. So now, that's the first thing you have to look for. And so let's looking at this chart. Looking at this chart of GBP USD on a 4-hour time frame, the market is clearly in an uptrend because we have a market that has been giving us a move during a series of higher highs and higher lows. You can see higher highs, higher lows, higher highs, higher lows, higher highs, and like that. So the market is in a clear uptrend and you want to be looking for buying opportunities. So the next thing you have to look out for are areas of value. What are the areas of value where the market is likely going to reverse from? And one of the things I do is that I scale to my lower time frame to identify areas on the chart, because if I do my areas of value on a higher time frame, I may likely not get the best area of value I want to be trading from. So now, right now, I'll scale to the 1-hour time frame and look for possible areas of value where I want to be trading from on my chart. Alright, so this is 1-hour time frame for GBP USD, and let's draw our areas of value. Areas of value are simply areas of demand and supply or support and resistance where the market has reacted to in the past and is likely going to react to in the future. So now, this is one area of value because this is where the market is currently at, and it is actually an area of support or resistance to support. It is the resistance around this place before the market broke out, and now it is now a support. And also, this is another area of value. But one thing about me is that I don't like to draw all this area of value if it is not directly connected to the place where the market is at currently. So maybe I can place an area of value here, which is not the best area of value, but then which is a place where if the market breaks out to the downside from this place, it is the next level target. So now, looking at the market this way, the market is actually currently at a support, right? And this market has bounced off this support at least 2 times, telling us the market is it is a high probability that the market is going to continue up and give us a lower and give us a massive ride to the uptrend. So now, in this kind of scenario, I want to be looking for opportunities to buy because the market is still in an uptrend, one, and the market is at the support. And you know, when it comes to support and resistance, support is where you are looking for areas to buy, while resistance is an area you are looking for areas to sell. And this market is currently at the support. Now the market is at the support, what do you want to do? And that leads us to the third thing you have to look out for before taking it, which is entry and exit triggers. What are the signs that you have to enter the market now? And what are the signs of where to exit the market? Apart from the fact that I actually enter the market at the support, some of the things I look out for, one of the things I use as confluence, if I want to enter the market, is candlestick patterns or candlestick charts. Well, candlestick pattern rather. The candlestick patterns are patterns that show me that the market is actually about to move. But currently in this market, I do not have a conviction that the market is about to move, because I need to like see a candlestick, maybe a bullish engulfing, a hammer, or a morning star candlestick that's going to tell me now I should enter. If you don't know all these candlesticks, I have like a video on candlestick charts or candlestick pattern. You can find that video in the description below and watch that on candlestick. So what I want to do is wait for a situation whereby the market is going to come back to this area of support, right? Maybe market is going to come back to this area of support, then give me maybe a bullish engulfing candlestick or another candlestick, and that's going to cause the market to go up. And if I want to set my exit or take profit, it's going to be somewhere around here, because this is the next level of resistance in the market, or the next level area of value in the market, because we want to be trading from support to support. We want to be taking from resistance to resistance, or support to resistance to resistance to resistance, which means if you want to trade the market, you don't set unrealistic targets. You don't set unrealistic target for your trade, because you know market moves from one area of value to another area of value. And you can see clearly this is an area of value that has been respected in the market a couple of times, right? So if I take my entry from this point, I'm not saying market necessarily have to come to this entry, but this place. But I know that when the market comes back, it's going to give me an entry trigger around this place. So one of the things I can use as a confidence also is the counter trend line. So sometimes whenever I do something like this, whenever I want to take trade like this, I place a counter trend line. I actually have a video on trend line strategies on my channel. I'm going to link that in the description below as well. So I place a trend line like this. So once I get the candlestick I'm looking for at this area, let me just draw this area. Alright. So this is place where I'll be looking for candlestick trigger, candlestick pattern that's going to tell me the market is about to go bullish. Right? So once I get the candlestick at this point, I then wait for more confluence, which is like market breaking out of this this particular counter trend line. Then once the market breaks out of the counter line, I'm pretty sure that this market is ready and is already shooting up, and I take my trade from that place. And I place my stop loss a little bit below where I put my entry, because I don't want to have a too wide stop loss, maybe like 20 pips or 15 pips stop loss, and I shoot the market up. So that is actually the first three things I look out for in a trade. Then the next thing is risk to reward. So now, talking about risk to reward, I said I don't want to be risking too much, and that is what risk to reward means. It means risk to reward is actually a very important aspect of your trade, because if you are risking too much for a small reward, then it doesn't make sense. It's now looking at like a gamble. So if I want to take a trade that is at least 1:3 risk to reward. So if we look at this right now, you see that this is 1:3, and my final target is this, which will be 1:5.5 risk to reward. And that is an ideal trade for any trader in the forex or crypto market. So now, sometimes I scale to more lower time frame, like 15 minutes, to take my trade, so that I can see clearly what is happening in the market. And the minimum I want to take is 1:3, because you want to be risking one thing to get three things. You don't want to be risking just one thing to get two things, or 1:1, which is like more like gamble, that you are risking 50 pips, for example, to get 50 pips. It doesn't make sense, because if you lose all your trade in that week, you are at a very huge drawdown. But if you are risking just 20 pips to get 60 pips, it means if you take trade, 3 to 5 trade, and you lose 2 of them, and you win the remaining, it's going to cover for the losses you are taking. So risk to reward is actually one of the most important things for you as a trader if you want to make money in the forex or the crypto market. So now, the last thing is trading psychology. And trading psychology is more like how you think during the trade, and how you think whether you are in a winning trade or you are a losing trade. So whether you are in a winning trade or a losing trade, you have to think like someone that understands the fact that the market is not perfect, and you also are not perfect, and the market gives you and takes from you. So whether you are a winning trade and a losing trade, you have to have the best psychology and the best approach toward the market, and know that the market is not always perfect, and you as a trader, you are not always perfect. You won't be right every time. So you don't get messed up when you have a losing trade, and you don't get too excited when you have a winning trade. So that is how to think whenever you are in the trade, and that is how a trader should think in the market. So this is where I'll be ending this video. If you get value from this video, ensure you subscribe to the channel, hit the like button, smash that like button so that more people see this, and I will see you in the next one. Also, if you have a particular topic on technical analysis, forex, or crypto you want me to cover on this channel, ensure you put that in the description box below, in the comment section below, so that I look into that and talk about it, and I'll see you in the next one.